Good evening, everyone. Thank you for joining us this evening on S-REITs, How to Identify the Best One. I'm Crystal, the Community Manager at ProsperUS. Let me introduce our speakers for tonight. We have Tim, content composer at ProsperUS, with over 10 years of content experience in the financial industry, including stints at Schroders and the Motley Fool. Tin believes that successful long-term investing is within everyone's reach. Next up, we have Boon, CGS-CIMB's Melbourne-based Chief Investment Strategist. With over 40-year career, he has worked in financial media and banking and finance. Among other things, he has served as Chief Investment Officer for DBS and Chief Investment Strategist for Standard Chartered Bank. Last but not least, we have Sudhan, Content Strategist, Investment Lead from Sydney. Being an investor of businesses listed on stock market for over a decade now, he is a huge advocate of investor education and believes in the act of paying forward. Allow me to share with you a little about ProsperUS. ProsperUS is a digital investment service launched this year to cater for the millennials. We aim to provide you with the best in-class service, and as part of our educational efforts, we have specially curated series like our webinars for millennials to gain more insights on investing. So with ProsperUS, you will not only learn how to invest, but also at the same time, enjoy curated lifestyle experiences. Having a busy schedule and want to invest on the go? Check out our recently launched app on Google Play and the Apple Store today. Follow us on our social media like Instagram or Telegram to keep yourselves updated on the latest news. Without further ado, I'll hand over the time to Tim to start tonight's session. Tim?
Hi guys. Thanks, Crystal, for the introduction. So I'm looking forward to this session because I think REITs are something that all of us in Singapore are obviously quite keen on, with the market here being healthy and obviously the income producing qualities that they have, as well as stability. So I'm just going to launch into a quick sort of 5-minute presentation on my take. I'm not going to bore you to death with slides. And then after that, we can kind of go into a panel discussion. I'll get Boon's thoughts as well as Sudhan's thoughts on, how they view REITs and their process. So first off, I'll share with you my screen really quickly. Hold on a minute. Sorry. Yeah. Okay. So So how do we identify the best REITs? I think before I start, let me just get through the boring compliance stuff, which is obviously this is all our own personal opinion and it's not meant to be construed as financial advice. So I'll just get that out there. I think that applies to all of us, including Boon and obviously Sudhan as well. So first off, I kind of want to understand, I think we should understand why we want to invest in REITs. It might be scary, probably not as scary as William Dafoe there, but it's really not as intimidating as we think. I think because it is a stock-like instrument, obviously there is volatility in it. It's traded every day, it's liquid, but it's unique in that I think actually gives you real estate exposure, to a whole portfolio of real estate, depending on which REIT you purchase. So you actually have exposure or ownership of maybe 100 different properties, and so the benefit of that is that you don't have to oversee it, right? So you can delegate that whole sort of portfolio of properties to a REIT manager, and so they will take care of that for you. And what you get is you get the free tax-free dividend income. So if you think about the distributions that they pay every quarter or every half year, they're all obviously tax-free. Whereas if you bought a property and you had to pay, I don't know, to like 1 million, 2 million, whatever it is to buy an income producing property, you have to put down a whole lot of money in terms of a deposit. And then obviously that income from the rent is taxable. So that's another reason to think about REITs, right? Obviously there's higher yields than bank deposits. You don't want to be leaving your money in the bank. That's just basic investing knowledge. And I think the last point's, something that doesn't get talked about enough is that I kind of view property as an asset class as sort of almost, undisruptible. I mean, whatever happens in the world, there will be a demand for property. People will need it. Either, it may not be commercial in terms of offices, maybe it will be more logistics, maybe it will be more, I don't know, data centers, or, maybe there will be a resurgence in shopping malls, who knows? But at the end of the day, everyone, there's a demand for real estate. So whatever happens, I think in the world, there will be a demand for property. It just depends on what type of property you're thinking about. Okay, so I've written something on sort of how I view, the top tips for investing in REITs and how you can, go through the metrics that you look at. There are lots of metrics, lots of different metrics. I've just picked, sort of 5 of my sort of favorite, how I think about REITs when I look at them. I've written that article, so if you check out the QR code, you can go to the ProsperUS website and read it in full. But I'll just kind of give you the quick rundown here. So, number one, it should have a reasonable gearing ratio. So that's basically, the debt ratio that it has, or the debt that it's taking on. In Singapore, there used to be a 45% sort of debt ceiling, and I think that's been raised to 50% recently. So, I think a lot of REITs tend to keep it below 40% just to be safe. They might be raising that up shortly, but you obviously have to think about, can they service that debt, et cetera, et cetera. Number two, they should have a strong sponsor. So I think this is something that relates to larger cap REITs. If you have a strong sponsor, that means you have a lot of good properties in the pipeline that they can acquire, the REIT can acquire. Obviously, probably on preferential terms, but also they have right of first refusal, which means that they can refuse certain properties if they don't want to buy it, but if they have the first dibs on it, if they want to buy that property. Number three, diversification. That obviously comes down to properties by number of properties, and then obviously by geography. You don't necessarily want the REIT to own like 3 properties, because then that's going to be too much concentration risk. 4, you want them to consistently increase the dividend or the distribution per unit, right? Because there's no point them paying out a pretty good yield, and then the next year they drop the distribution, or the distribution gets cut. So what you want to look for is consistent DPU increases, hopefully over longer time periods, because that kind of proves to you that they have a track record. And then 5, you want a long weighted average debt maturity, so that they've proved to you that they're managing their debt load responsibly, and that they've got good sort of capital allocation as well as debt management. Other things to consider are, all these. I mean, I've written things about why Singapore REITs, if they're bigger, they tend to be better, more liquid. But the bigger REITs tend to have advantages, in terms of the properties that they can acquire, the amount of debt they can take on. So they have a lot more firepower to purchase properties. And so these are a few other things that I think we should obviously think about. Interest cover ratio relates to servicing debt. And then the weighted average interest rate, which is obviously REITs are effectively taking on debt to acquire assets. So they need to manage that debt responsibly, and hopefully they can get a low interest rate when they take on that debt to acquire stuff. And then finally, you have, Forex risk management. If there are overseas properties, then they'll have probably income in a different currency, and then they need to hedge that, and they need to manage that, because they'll be reporting back into Singapore dollars and probably paying out their distributions in Singapore dollars. Okay, I think beyond that, I kind of want to just take a look at this really interesting chart that I had seen actually in the BT recently, the Business Times. And so I kind of view REITs similar to stocks, right? There's quality. And if there's quality, you want to stick to quality, because quality tends to win out over the longer term. So I think if you're thinking about 6 months or a year, that's not really long term. So what you want to do is you want to look at track records and understand why these particular REITs are doing well, if they have been doing well. And you can kind of see here that, the top 10 have all done, I think, considerably well compared to the Straits Times Index, which is obviously a poor benchmark. But the Straits Times Index, for example, has produced an annualized return over the past decade of just 4.1%, right? So even the worst REIT on this is nearly double what you would have gotten by just putting it into the Straits Times Index. So I think understanding that these REITs that are riding the structural trends, that are continuing to deliver both on sort of the DPU increases, on acquisitions, on management, I think they continue to do well. And I think that's something that I think we should think about, and remember that REITs aren't all that different to stocks when we think about investing for the longer term. And that's, applicable to being in the right sectors. I think the structures, this is a sort of a returns profile that I took from our research team, just looking at the 10-year and 20-year price returns, as well as 5 and 3. So you have price return and total return. I've just highlighted a few of the ones that have disappointed recently, right? So if you think about property developers, they sell, residential developments. So you'd think, oh, they're getting great, a lot of money from revenue when they sell a project, but a lot of their revenue is lumpy. And so they've kind of realized, I think Capital Land has kind of realized that this isn't really beneficial to shareholders, which is why you've seen this recent sort of restructuring of the group, just because the returns have been really, really poor over the past sort of 5-10 years. Same with city developments. It's been a poor stock to hold over the past 10 years. Something like a Hong Kong Land looks like it's being disrupted because it has a lot of commercial property in Hong Kong. They've just carried out a share repurchase, but you could argue that's not a really good use of their money. And then finally, you have a really big REIT in Capita Integrated Commercial Trust, but that doesn't guarantee performance just because it's massive. So we really have to think about where are these sectors, where are these REITs operating in? Are they in good sectors? And just like stocks that operate in specific sectors with tailwinds, you need to be in the right real estate sectors that have tailwinds, as well as focusing on, quality management. So I'll leave it there for my bit. Before we kind of hit the panel discussion with Boon and Sudhan, I just wanted to kind of cover upcoming sessions that we've got. So we've got something on the 7th of October focusing on Hong Kong stock market. So I think a lot of people are, running scared with Tencent and Alibaba and Meituan, but to be honest, there are so many more quality stocks in that market than just those three. There are so many different companies there that operate that are not in this tech spotlight, and just absolutely amazing businesses that you'd be surprised have done better than Tencent and Alibaba over the past 5-10 years, right? But no one talks about. So we kind of are going to take a look a bit more about the market structure in Hong Kong. Some of the best long-term winners, which are never in the news because they're not being, focused on by the government. They're just getting on with their business and doing well. And the minimum lots, it's a different system in Hong Kong. So it's something that if you are investing into the Hong Kong market, you'd have to just be a bit more cognizant of. And then in late October, we're doing an ESG series covering, environmental social governance. I think this is a big thing that has really taken on a life of its own over the past year in terms of how we view investing, and not just focusing on shareholder returns or profit, and think about the company and whether it's sustainable, whether it's generating a positive impact on the planet, if that's going to help with the sustainability of the business. I think that's all going to feed into future shareholder returns for investors. So that's something we definitely need to be more mindful of when we invest nowadays. So that's in late October. Before I move on, I think Sudhan, you wanted to cover something here. We've got the ultimate guide to Singapore REITs that Sudhan has prepared. So Sudhan, I guess you can kind of take everyone through this.
Yeah, thanks, Tim. Yeah, so Tim highlighted a few articles that you can read. Tim writes great stuff for ProsperUS. I'm a huge fan of his articles as well. I've learned a lot of stuff from his articles. So if you want to learn more as well in the REIT space, Seedly, we have exclusively created this guide on Singapore REITs. So what you can learn is basically the advantages, disadvantages of buying REITs, the different types of REITs in the market now, choosing the best REITs. Tim covered some of the points as well. Also, we have a section on REIT ETFs. So those who don't want to pick specific REITs, you can consider the ETFs in that space. So yeah, you can scan the QR code here, and you can go directly to Seedly's website. You can sign in and then download your report. Yeah.
Okay. Thanks, Sudhan. Yeah. Remember you did one on China, which was really great, really interesting report. So I'll be looking forward to that one as well. Sorry, okay. So I think we can kind of stop it there, and I think hit up Boon and your thoughts before we talk to Sudhan on how do you view the REIT space, Boon? I mean, how do you think about investing in REITs, and what do you look for?
Well, Tim, thank you very much. Look, you've covered many of the technical points very comprehensively and very competently. So perhaps if I could just give you a big overview of what I would look for in a REIT over the longer term. Yeah. So if I can boil it down to three things, I'd be looking at the quality of the assets, I'd be looking at growth, and I'd be looking at valuation. Right. So if I can sort of backtrack and deep dive a little bit more, when I talk about the quality of the assets, that would be equivalent. If you were looking at a stock, that would be equivalent to the sustainability of a company's or a stock's business model. Right. So in the case of a REIT, the sustainability of the business goes to, if I can boil it down again to 2-3 things, it would be location. It would be, and location would be country, and then you zoom down to the local area, right? It would be the sector that you're in. And within the sector, it goes to the demand and supply of properties within that sector, within those locations, right? And it also goes to the defensibility of the assets. So in other words, it's about the market positioning of the assets, right? So we're thinking about stock here. This would be equivalent to what Morningstar calls moats for stocks. So if you imagine a castle, what sort of moats do you have around the castle to defend the castle? So in other words, if you have a shopping mall, for example, what are your moats around that shopping mall or the office tower? The brand name, the location, the specific sort of proposition that you have, even the attractiveness of the building itself. So that's the quality. That's what I mean by the quality of the assets.
Right.
And I spoke about growth. Well, growth is fairly straightforward. It's the growth potential of the country or the sector that the REIT is in, right? Then we talk about valuation. So even if you have great assets, you can overpay, You can overpay for great assets, resulting in a lack of capital gains, which drives growth, right? So you can get the income, but REITs, as I'm happy to talk about later on, it's not just about income, it's income and growth. Because if you're looking purely at income, you buy a bond, right?
Yeah.
So you're looking at both income and growth. So if you overpay, you may have to wait a long time for the growth to kick in.
Yeah.
Right? For the value to realize itself. So you want both income and growth. So in a sense, you want to have a REIT where you're paid to wait, but not wait too long. So if you don't overpay, you don't have to wait too long. So you get income while you wait for the valuation of the underlying asset to rise. If you overpay, you wait a long time. If you don't overpay, you may not have to wait that long.
Yeah. I think when you talk about the trifecta of quality, growth, and then valuation, like what would you say is the most important? Because from my perspective, when you say those three, I always think the quality of the assets, because that gives the REIT, the pricing power to raise rents, to continue to extract more money. So, is that at the end of the day, the key thing for you?
Yeah, look, I totally know where you're coming from. Of course, the quality. So it's very hard to choose one. But if I had to choose one that captures it all, it would be valuation, because the valuation is also relative to the quality of the assets. See, because when you look at valuation and you look at the yield and all that, so that captures the quality sort of aspect as well, right? So if I had to choose one, I would choose valuation. Okay. Because that captures everything, what you're paying relative to what they're receiving, which hopefully would also reflect the quality of the asset. Yeah.
Okay, thanks. And so Sudhan, how about yourself? I mean, what do you look for when you're investing in REITs yourself? I mean, what's important to you as an investor, especially over the longer term?
So for me, Boon covered a lot of points, Tim as well in the slides. So I think what I will, where I beg to differ is actually in the valuation part. So for example, there's certain REITs in Singapore, even though they have been highly valued over the past few years, they have been growing even more than the general market. For example, Keppel DC REIT, it has never been below price to book of, for example, 1, a metric that a lot of investors like to look at. So any REIT that is below PB of 1, you can say it can be said to be undervalued. But Keppel DC REIT has never traded, to my understanding, since its IPO in 2015, it has never traded below a price to book of 1. So even during the COVID crash in 2020, in March, the lowest it ran is price to book of 1.5. Prior to that, it was at 1.3. So it always traded at higher valuations than average. Yeah. But it has gone on to actually be the best performing REIT so far. Tim, you showed the slides for the past 10 years, but since it was listed only in 2015, history, there's not much history there, but it's actually the best performing Singapore REIT. So I think in terms of valuation, I think the Singapore market has matured since the listing of CapitaLand Mall Trust in 2002. Like, more people know about Singapore REITs. It's more people, more investors are coming on board. So I think certain REITs are being valued like growth companies in the US. Your Mapletree Logistics, your Mapletree Industrial, Parkway Life, Keppel DC REIT. So these REITs, the stronger companies tend to keep on winning. Like, winners keep on winning, like we learned from Motley Fool, right? So so I think the market has matured, I feel, Singapore REIT market. So in that sense, I would pay more attention to the quality of the REIT itself. And let's say I feel the REIT is expensive in terms of price to book or dividend yield, I would personally buy a bit of the REIT and then wait out, and then we buy a bit more when market corrects, or as I learn more about the REIT, I would maybe buy a bit even more. So I would pay slightly less attention to valuation if it's a super great REIT.
Yeah, that's an interesting point. I think when I think about the sectors, like, say, I think you had written a piece last week that was quite interesting about sort of the office space, and also sort of the hospitality space, right? So I think hospitality, obviously travel will always be there and that will come back. But if you think about valuations coming down, and obviously, I think commercial REITs and maybe retail REITs are cheaper, but do you think they're cheaper for a reason? Because maybe, I guess no one knows what's going to happen post-COVID, but it seems as though even in Singapore, we're kind of moving to a hybrid environment post-COVID, where there will obviously be a need for office space, but how that office space is used will be different. And then, ergo, does that mean that there will be less total demand for office space because there's not going to be, 100% of people going in every day? So do you think that it's cheaper because maybe there's a structural re-rating, or do you think that it's an opportunity that, that we're going to be going back to normal? Because I think that's a big risk that you have to take, obviously, if you're going to buy it, right? I assume.
Yeah. So when you talk about valuation, I mean, valuations are not just about price to book, although price to book is an important consideration. So, and to Sudhan's point, and I can't comment on Keppel DC. I have to be quite transparent about it. I'm a board member of a Keppel linked company, so I won't comment on that. But you have to look at the valuations relative to their peers, right? So there are two methods of valuation in the sort of investment analysis sphere. There is your absolute valuation, right? And there is relative valuation. So absolute valuation revolves around discounting of future cash flows. So in the case of REITs, it would be essentially the DDM, the dividend discount model, applied to a future sort of income stream. But this is theory here, and it's for the individual investor, it is not particularly practical, right? And there's a reason why it's not very practical, because the calculations are quite tricky. So when you look at fair value, Tim, and you have written about this and you shared this with me, fair value is D divided by R minus G, right? Where D is the next financial year's dividend, and the R is the cost of equity, and the G is the growth rate of the dividends into perpetuity. But the problem is, how do you determine the R and G? So it gets very, very complicated. So for practical purposes, we usually go back to relative valuation, right? So it's relative to your peer group, right? So when you talk about a data center REIT, you got to compare the valuation relative to their peers. So you would certainly expect that, and you talked about the hospitality sector. There is a reason, Tim, you're absolutely right. The reason is that hospitality in this particular sort of environment would be the last mover on the reopening. Because the first thing you've got to do is to be able to get people out to the shopping malls, to the hawker centers, to the restaurants first, right? Because if you can't get them out safely, you can't have tourists coming in and out, right? So I think the early movers in the reopening theme would probably be your shopping malls, and then followed by the offices, because they can stagger the return to the offices. And of course, the data centers have never been affected significantly by lockdown, which is why the valuation looks expensive. It looks expensive relative to what? So relative valuation. Look at it relative to its peers. Right. So yes, hospitality is cheap for a reason, because it will likely lag until we are further advanced on herd immunity or vaccination or combination of both, right? So there,
that's a good point. I think for you, Sudhan, like when you invest in REITs and you say you want to start a portfolio of REITs, like how do you think about how you're going to structure, your portfolio? Are you looking more at sort of REITs with DPU growth, or are you looking more at the growth potential of the REIT, or how do you think about it, or the yield? I mean, how important is the yield when it comes to, sort of constructing a portfolio of REITs? Like, how do all those things interact for you, like when you think about, REIT investing?
So you touched on the point of yield. So Tim, you initially talked about DPU increases. So the yield is actually the last thing that investors have to look at. I know that's the headline numbers that is always flashed by the media, by news and stuff. But then we have to look at the sustainability of the yield instead of just the absolute number. So in terms of DPU increases, is it consistently increasing? The gross revenue, net property income, are they increasing consistently? So if the gross revenue and net property income are increasing, but then your DPU is actually coming down, it might mean that the REIT is doing a lot of rights issues and diluting shareholders. So that's the reason, one of the reasons for DPU to come down. So I think sustainability is one for me. The sustainability of the yield. Another one you mentioned is the growth prospects. That's also what I look at. But in terms of portfolio construction, for myself, so I used to own quite a number of REITs. So I liquidated a lot of my REITs just earlier in 2020. The main reason is because I'm gunning more for growth instead of dividends. So I started off as a Singapore investor, and I was always been in Singapore. And as I learned more about US stocks, global stocks, I've diversified my portfolio as well. So I think portfolio construction, I think, is back to the individual. What is the person looking for? Is he looking for income? Is he looking for growth? And depending on that, I think portfolio construction is different for each person.
Yeah, that's true. That's true. Yeah, thanks for that, Sudhan. I think, we talk about REITs as an sort of, income generating real estate exposure, but there's always worries about the rising interest rate environment. So do you think, Sabun, that REITs can still do well when the Fed does eventually raise interest rates? I mean, is it going to be impacted, or can investors expect those REITs to hold up and continue to pay their distributions and continue to deliver?
So much has been made about the negative impact of rising interest rates on REITs. I think too much. We go back to the basics of REITs: the quality of the assets, which I referred to earlier, and the defensibility of those assets. So the argument that rising rates are bad for REITs, that argument is based on the idea that REITs are pure income plays.
Yeah.
Right? That is so. The assumption is that it behaves exactly like bonds. The rates go up, the inverse of rates, or the risk-free rate, which is your bond valuation, goes down. But REITs are not bonds.
Yeah.
Bonds are debt instruments and do not participate in the upside of the business. You get paid your fixed income, that's it, go away, right?
Yeah.
REITs do participate in the upside of the business. So if you have rates rising because the economy is doing well, then REITs holders participate in the upside of a strengthening economy. Yeah. So that's important to know. So in a stronger economy, REITs, provided they have quality assets, so we go back to that point again, will have more power to set higher rentals. They have more bargaining power. So indeed, if you are talking about fear of inflation, which is also linked to rates, yeah. So right now, rates haven't moved, but fear of inflation is here, right? People are fearful of inflation even before rates have moved. So if you're talking about fear of inflation, I would actually argue that REITs fall in the category of hard assets.
Yeah.
Assets that investors look for as inflation shelters.
Okay.
So what are hard assets? We're talking gold, right? You're talking commodities. You're talking property.
Real estate.
And REITs are simply investment vehicles for properties. So look, and historically, and I wanted to get some numbers up. So if you allow me to sort of quote a few numbers.
Go for it.
Historically, recent periods of rising rates have actually been favorable for REITs. Between April of 2004 and September of 2006, right? April 2004, September 2006, the US Fed funds rate went up from 1% to 5.25. That's a huge jump.
Yeah.
Right? But the Wilshire US REIT index went up 100%. Right? Crazy, right? So more recently, let's look at a more recent history. That was a more recent history was in October 2015 to February 2019. October 2015 to February 2019, and rates were going up as well. But the Wilshire US REIT index went up 20%. So I don't read too much into that, right? So if people are panicking and selling on fear of rate rises, I'd be fine.
Yeah. Okay. No, that's a good point. Yeah. I feel like the latest period of interest rate rises, we didn't really feel it much in terms of REITs, right?
To begin with, we have not even seen rate rises. The bond yields are not going up.
Yeah, they had to cut yields after they cut rates right after COVID struck.
So look, I think if there is, to me, if you're looking at Singapore REITs now, the bigger concern should be the path of reopening.
Right.
Rather than this very theoretical thing about US rates, right?
Yep.
If US rates go up because the economy is doing well, good for them, good for us. We are all winners, yeah? I think the path of the reopening in Singapore is more critical for the retail and for the office REITs, for the retail and the office REITs. Your logistics are less affected. In fact, logistics have been a beneficiary of lockdown, right? Because we are all doing all these sort of online retail.
Getting things delivered to
us. E-fulfillment is a big part. So logistics, data centers have been big winners of lockdown. So for the office and retail REITs, the path of reopening is more important. Right now in Singapore, there's a lot of nervousness about where we're going to go. And if you look at REITs over the last week or so, they have weakened. They have the office and the retail REITs, they have weakened. So watch that. That's more important.
Okay, so I think to wrap up soon, we're just going to touch on our favorite REITs. But before I do that, I think, I just want to remind the audience to put your questions in the Q&A box at the bottom. If you have anything to ask any of us, the panel, just, type it in there and shoot it off, and we'll get to it at the end. So I think, to wrap up, Sudhan, what are among your favorite REITs, in the market, say over the longer term, and why?
So Boon touched about the better REITs like logistics REITs. So I personally like logistics REITs because like we mentioned, e-commerce is a huge beneficiary of online digitalization, and these REITs like Maple Tree Logistics, Fraser's Industrial and Logistics Trust have been resilient and strong. So why logistics? Because the goods that we buy online, they have to be stored somewhere, and they are stored in warehouses, and a lot of these REITs own these warehouses. So I like logistics REIT. Another one is Capital DC REIT, which I touched earlier, data centers. Data is only going to explode going forward. In fact, COVID has accelerated tech adoption, and I think we're just in the beginnings of digitalization. So I think over the long term, I think Capital DC REIT would do well as well.
Well, okay, great, thanks. Boon, how about yourself?
Look, I'm going to be consistent with my broad theme for equities. So I've had this broad theme for equities since fourth quarter of last year, which is to rotate from the lockdown stocks, the pandemic stocks, to the reopening stocks. So in the equity space, as you know, Tim, I've been essentially switching from tech to banks, to financials, to energy stocks, and to industrials. So consistent with that theme. So logistics for me are beneficiaries of lockdown, and they're still doing well. There's no doubt about it, because we are still in a pandemic. We are very clear about that, right? So, but I'm trying to look past that a little bit and look for the value beyond the pandemic. So if you like, I'm looking for the more patient plays. So I'm wary of the hospitality because I'm not that patient, right? Because that is a 2023 play. Let me repeat this. This is a 2023 play because I do not think, well, look, Singapore is vaccinated, 81% double vaccination. We're calling people back for the third shot. But the rest of the world is not there yet. Even in Australia, where I am now, hey, double vaccination, 45, 44%. That's how badly a lot of countries are lagging. So travel will be a lot later, but I'm just a little bit more hopeful that Singaporeans can work through this period of uncertainty and difficulty and, get out and dine and shop again. So I'm looking at the retail REITs, and you know this, Tim. I've been looking at Fraser's Centrepoint Trust. So I go back to the quality of the assets, right? So, and I hear what you say about diversification, right? So now, Fraser's Centrepoint Trust is not a diversified trust. So if you want diversification by geography, this is not it. This is a pure Singapore reopening play. And the reason I'm going for Singapore is because Singapore is the most vaccinated country in the world, right? Yeah. So, and within that sort of concentration within Singapore, the assets are really quality. You're talking about really iconic names, right?
Yeah.
On the east, you've got Changi City, Tampines 1, Century Square, White Sands, right? In the north, you've got North Point, Causeway Point, they've got a lot of points. Waterway Point. Waterway Point, they've got Hougang Mall, and then in the middle, they've got Tiong Bahru Plaza. These are all names that we all go, I used to go to anyway.
Like a lot of Scotland malls, right? As, it's the things that I think everyone needs to kind of visit, right? Whereas I think they've done better relative to maybe a capital and integrated commercial, because their kind of malls are maybe in the CBD areas, like maybe people aren't going in all the time.
Exactly. So, the Kame, our REIT analyst, she says, heart, love, heart, the heartland malls, right? Okay, so this is essentially a heartland Singapore play, right? They do not depend on tourists, right? So this is quite different from an Orchard Road mall, right? So these are where people live and people shop and people eat, people dine at. So we go back to some of the things you talked about, the WALE, or the weighted average lease expiry. It's not very long, to be very fair, for Fraser Centrepoint Trust. You're looking at about 1.5 years, but 1.5 years, I believe, will work us through this pandemic. I certainly hope so anyway. So the occupancy rate is still very, very high. They are looking at Tampines 1, they are looking at 98, 99%. So it's full, right? But the average occupancy, I believe, is around 96 to 97%, which is still very high. So I hear what Sudhan says, that don't focus on the historic dividend, right? So we look forward. We look forward. So our analysts are forecasting the FY22 dividend payout at 13 cents. 13. So at 13 cents, that's 5.7% based on today's price. Today's price, when I last saw it, was 227, right? And coincidentally, the book value is 227. Right?
Okay, great. I think I'll touch on mine before we go to Q&A. So I think my favorite is just Mapletree Industrial Trust. I think similar to Sudhan as well. I think Mapletree Logistics is a great trust. I think the whole Mapletree family tends to be sort of top notch in terms of how they manage properties. Management of the REIT, alignment between manager interests and shareholder interests. I think they're aligned quite well, the Mapletree family. And I think with Mapletree Industrial, what they did right, sort of 4 or 5 years ago, way before this whole pandemic, is they actually diversified into data centers. So they were quite prescient in terms of where they were going. I think going back to Sudhan's point about Keppel DC, it does trade at an expensive value. I mean, expensive in terms of price to book, and same with Mapletree Industrial. But I think the point I would make to listeners is that I think they trade at that expensive valuation because there aren't that many of those types of REITs in Singapore. For example, Keppel DC is the only pure play data center REIT in Asia. So in the US, you're going to have quite a few. You have like Realty, you have Equinix. You have quite a few different types of data center REITs. But in Asia, the only pure play one is Keppel. And then the only one outside that has data centers is Mapletree Industrial in Singapore. So I think they trade on a valuation that reflects that there's a scarcity of those types of assets that are listed in Singapore. If you do believe in the growth of that, that asset class, and you look at the DPU growth that Mapletree Industrial has posted over the past 10 years, you can start to understand why. But I like them because of their, diversification with geography. They've got a lot of quality assets in Singapore. They're upgrading some of their advanced manufacturing, traditional industrial properties. And then they've also got, a big portfolio of data centers in North America. So, across the US and then also in Canada. So in total, they've got about 114 properties. They've grown that, quite significantly over the past 3 or 4 years, and they've managed to do it at a really reasonable sort of gearing ratio, while also growing the DPU, right? So I think that for me is the key metric. If you think about a lot of REITs, they always say, "Oh, I've got, we've raised distributable income 50%, but we're gonna raise the DPU like 2%." Okay, so how did that make sense? So I think you have to think about what is the DPU, because the DPU matters to you at the end of the day. That's the thing paid out to you. The distributable income, in my eyes, is actually quite meaningless, because that doesn't really relate to anything to my payout. So if the distributable income is not getting translated into a correspondingly large DPU increase, or something that reflects where it should be at, then there is probably misalignment of interest between management and unit holders. So that's something that I think Mapletree Industrial and Logistics have really managed to deliver on, and particularly industrial. So I think that's one of the key reasons why that's my favorite REIT over the longer term. So I think that wraps it up for us. So I think for Q&A, we have got a few questions from the floor. So I think we can flash those up on the screen. Okay, let me see what we have here. Okay, so I guess I can shoot this off to you, Sudhan, first. Okay, so earlier you mentioned the debt ceiling has increased to 50%. Okay, so do you think that's better, or do you think this means companies are gonna just be in more debt now?
Yeah, so I think in July last year, the Monetary Authority of Singapore raised the debt ceiling from 45%, basically the gearing ratio, from 45% for Singapore REITs to 50% to help REITs tide through the pandemic. But I think personally, I hope the REIT doesn't leverage up until 50%, because I think it's going to be a temporary raise of plus 5%. If the pandemic blows over, hopefully, and we go back to normalcy, I think the REITs, the percentage might come down. In that case, if the REIT has a gearing ratio of above 45%, it might need to do rights issues and stuff like that. So I don't want my REIT to go into those kind of issues. So what I would do personally is to make sure the gearing ratio is below 40%. So at least there's a margin of safety in terms of gearing ratio. Yeah. So it's not necessarily good for the REIT. Maybe it's good for the short term, but by the end of the day, it's a long-term thing. So I would be conservative and keep it to below 40%. Yeah.
So Boon, what do you think?
I really don't make too much of it. 40, 50, it's even at 50%, it is very conservative.
Yeah, I think they tend to be conservative anyway, like the REITs.
And most REITs are below that 50%, 40% threshold anyway. Yeah. So I don't make too much of it. Yeah.
Yeah. Okay. We've got another couple of questions. We can get the next one up. Let's see what is. Let me just put this up on here. Okay, so should investors be concerned if a mall that's part of a REIT they invest in becomes, I guess, a COVID cluster, has to close for 2 weeks or more for cleaning? Okay, so like the ongoing Bugis Junction cluster. I don't know, say Boon, what do you think about that?
Yeah, look, you would always be concerned about that, but you got to take a bigger view of these things. It is never good when tenants cannot do the business, right? So, but this is something that is probably going to affect a large number of malls as we work through the reopening phase.
Yeah.
It's going to get to a phase where there are hardly any places that won't be touched at some point. So I'm just trying to be as direct and yet gentle as I can be. This is going to be quite common, right? So the REITs will still, the tenants will still be paying rent, whether there's some rebate that probably has to be looked at. But I think, yes, it is not good, but in the greater scheme of things, that is probably already in the price.
Okay. Thanks. Okay, so I think we've got one more question, final question for tonight. So I think we're going to be done within the hour, which is good. Okay, appreciate your thoughts on buy and hold strategy for REITs. Okay, lifelong income stream versus opportunity costs of faster capital appreciation from tech stocks. Okay, I think I can kind of give my 2 cents on this. So I think it's a very individual choice, how you think about buy and hold, and whether you want to take on more REITs or you want more income or you want to take on more risk with tech stocks. I think it is completely dependent on your risk appetite. I mean, some people are quite happy with a lot of their portfolio or the 100% of their portfolio in growth stocks, and they're very comfortable with 30% price swings on a regular basis, right? But then other people can't sleep at night and get worried about that. So I think whatever you are comfortable with and you know yourself as an investor and your temperament, I think it's important to play to those strengths. I think obviously you have to understand with REITs, the capital appreciation over 10 years is not going to be, the upside might not be at the level of a tech growth stock in the US, but it will likely be a lot less volatile, right? So you're going to have trade-offs in certain areas. But I think if you're younger, you can take on, you should be taking on more investment risk to generate returns. But having said that, I would use the caveat of you need to be comfortable doing that and you need to know what you're doing. So, but I think REITs deserve a place in everyone's portfolio, whether you're 20 or 40 or 50, whatever. I think everyone should own some REITs.
So Tim,
yeah, sorry.
Perhaps if I can jump in here.
Yeah, go for it.
I totally agree with you that REITs are not going to give you the sort of very high returns that you get from big tech, right?
Yeah.
And that's not been the history. But the idea that you get a life of income versus growth is a false dichotomy. It's a false dichotomy because if you go back to what I was saying earlier, REITs are not bonds, right? Bonds are bonds. Bonds, you don't participate in the upside of the economy, the upside of the business, right? REITs are a hybrid of income and growth.
Yeah.
Right? So, and this is just to share with you some data if you look at the returns from Singapore REITs, so I'm talking the S-REITs here to be very relevant to the audience here. If you look at the returns of S-REITs over the past 10 years, it's been not close to 9% compounding every year.
Yeah.
Right. 9% beats the heck out of the STI.
Yeah.
Right. So,
yeah.
So I think that sort of income versus growth is a false dichotomy. The total returns from both the income and growth, we're talking about 9% a year.
Yeah.
You know?
It's a lot. Yeah. I mean, what do you think, Sudhan, on how you think about buy and hold for REITs, generally, versus, I guess, tech growth?
Yeah, I think I have the same views as you, Tim. Like basically, are you comfortable sleeping at night with what you have? With the big techs versus the REITs. So yeah, I think at the end of the day, it's up to the individual.
Yeah, definitely, right. I think it depends on like their risk appetite, I guess.
Yeah, the volatility for big tech will obviously be a lot higher than the volatility for REITs,
Yeah.
So it's not just about the returns, it's also about the risk adjusted returns.
Risk adjusted, yeah, for sure. Okay, I think we've got two more. If we can quickly go through those. I see that we've got two more questions. Okay, earlier this month, quite a number of Singapore REITs entered the global REIT benchmark. I think that's the NA REIT benchmark, right? Is that a good identifier that it's a good REIT to invest in? Sudhan, what are your thoughts on that?
I wouldn't really read too much into it. I think basically when a REIT enters the benchmark, I think it just means that it's huge enough to be part of the benchmark.
Yeah.
That it doesn't really say much about the quality of the REIT. Yeah. So I wouldn't read too much into it.
Yeah. Yeah, no, I agree with that as well. I think we've got one more question which we can get through. Okay, how do the best S-REITs stack up against other REITs around the region? Okay, that's an interesting one. Say, Boon, do you want to start off? I mean, I guess Australia does have a REIT market as well, but then obviously Hong Kong. I know Japan, but obviously I think Japan's a bit less familiar. People are a bit less familiar with Japan. But how does it compare?
Look, I think that's almost an impossible question to answer in short. Yeah. As I said, when you compare REITs, you've got to compare them against a peer group, right?
Yeah.
So if it does not make a lot of sense comparing REITs on any valuation parameters between Singapore and Australia or Singapore and Japan. The interest rates are different. The growth rates are different. The dynamics are very, very different. So when I look at REITs, I tend to look at them relative to their peer group. And within Singapore itself, it is complicated enough, right? So if you look at the overseas REITs, okay, so to Sudhan's Tim, to your point, things are cheaper for a reason. So if you look at the overseas REITs, the valuations are much lower, yeah? And Sudhan also said that valuations per se, do not tell you a lot. It's valuations relative to what? So if you look at the overseas REITs, and you've got quite a few of the S-REITs, which have the assets overseas, right? Yeah. So, and their valuations are a lot lower. So the comparison has to be very specific.
Yeah, I think, no, I agree. I'm from Hong Kong, so I know a bit about the REIT market in Hong Kong. I think maybe that would be, there's always a comparison between Hong Kong and Singapore. So I think for me, the comparison there is the market in Hong Kong is a lot smaller in terms of the amount of REITs that you can access their quality. I mean, Link REIT is the biggest, the biggest REIT. It's like sort of the sort of 800-pound gorilla REIT in Hong Kong, right? But after you get through Link REIT, there's really not as much breadth or choice as you would have in Singapore. I think that has to do maybe with the assets that they've got, the kind of REITs that are in Hong Kong are a bit smaller, and they've got mainly office properties in Hong Kong. They haven't really expanded overseas. And so what you've seen in Singapore, at least what I've seen over the past sort of 3-4 years, is Singapore REITs really starting to use like their firepower to acquire properties overseas. And that's something that hasn't really happened that much in Hong Kong. Link REIT has started to go into mainland China. It did venture a bit into Australia and I think UK, but that's only happened in sort of like the past 2 years. So if you think
exactly
about
right, Tim. So a lot of the S-REITs are not really Singaporean.
yeah,
in terms of the assets, right? So it's very hard. So the reason I looked at Fraser's Centrepoint because it was a pure play, it was a pure Singapore play, right? And there are very few pure plays around, right?
Yeah, exactly.
And you know, for example, I looked at OUE Commercial Trust, which is cheap, but it's cheap for a reason because it holds the hospitality.
Yeah,
right?
Exactly.
It holds a property in China where the valuations are lower. So you get what I'm trying to say. So it's very hard to be very broad brush and say Singapore REITs are better or Singapore REITs are worse.
Yeah. Sudhan, what are your thoughts on regional REITs? If you like have any thoughts on REITs around the region, or are you more just focused on the S-REIT space?
So for myself, I'm focused more on the S-REIT space, but like Boon said earlier, it's not apple to apple comparison if we were to look at regional REITs versus Singapore REITs, because there's so many differences in terms of regulations, in terms of demand and supply. So, but I would like to add another point, add on to what Boon said in terms of overseas assets. Singapore REITs with overseas assets and their valuation is much lower relatively. So that's actually an interesting opportunity if the investor understands, for example, US office market. Probably the investor has been to the US, stayed in the US, but he's a Singaporean and he understands the market intimately. Actually, there's an opportunity for him or her to actually look at this space, because Singaporeans don't really understand in general, because we are living in Singapore and those assets are listed in the US. The properties are in the US. So in terms of that, I think there are opportunities here and there if you really understand the market.
Okay, right.
And to add to what Sudhan was saying, US REITs are interesting for another reason, because it gives you better diversification. So Singapore REITs have a higher correlation to the STI than US REITs have a correlation to the S&P 500. So US REITs long-term correlation to the US stock market, the S&P 500 is only 0.45. It's very low. It's much lower than the correlation of the S-REITs. The S-REITs against Asia ex-Japan equities, I wouldn't call it high, but it's not low either. It's about 0.6 plus. Right?
Yeah. No, that's an interesting point. Okay, I think we are at the end of the session. I think we can wrap it up now. I think Crystal's gonna wrap it up for us. So I would like to thank you, Boon and Sudhan, for joining. I've had a really fruitful discussion on REITs. I hope everyone has kind of picked up a few things. And I'll hand it over to Crystal now.
Thanks, Tim, Boon, and Sudhan for sharing with us on S-REITs. And thank you, everyone, for joining us tonight. For any queries, you may reach out to us via email at hello@prosperous.asia. Before you go, please help us fill in a short survey for us to understand you better. For those on Zoom, the survey will actually pop up after exiting today's session. And for those who are on Facebook, please scan the QR codes on the slide as shown, or in this link for the survey. We hope to see you in our upcoming sessions, and good night.
Thanks, everyone. Thanks.
Thank you.
Bye. Bye.